Hello value investors, thank you for joining me. Today I want to talk about Fastly and why Fastly is not actually that expensively valued. So stay with me while we go through its revenue growth rate that got revised last night, what it means to that dollar-based net expansion rate, bringing that all together into its valuation. If you haven't done so already, don't forget to check out my marketplace right above there, Deep Value Returns. You can do that on Seeking Alpha and you can find out which stocks I own and why, and you're welcome to do a totally free trial. So let's get started. So here is the thing. Fastly last night removed its Q4 guidance and it downwards revised its Q3 guidance. Now, previously Fastly was expected to be growing into Q3 at 49% year over year. Now it's come down to at the top end 43% year over year. On the surface, that is not a big difference. It's just a few million on a company that's valued at approximately 13 billion. Now afterwards, the downward after hours reaction is down to approximately 10 billion. But what it actually means is that the premium that people were paying, investors were paying for that visibility to be able to say that the company is growing at 40% without any questions asked, now is not so clear. So it also generates another question, which is all these SaaS stocks that investors are paying very large premiums for may actually be possibly, I don't know yet, maybe towards a bit of an overpriced side. I don't really know yet, and we will know a lot more as we go through the Q3 earnings seasons. But what it does mean is that in the case of Fastly, it's that digital acceleration theme that Fastly should be benefiting may actually not transpire to be the case. Said in a different way, that Fastly bills its customers on a usage based, and that's why its net expansion rate is so strong. You can see here on the screen the net expansion rate has been quite consistently above 130%. Now it says, okay, if you look at the second bullet point of the press statement, it says that a few customers had lower usage than Fastly had been expecting. So it means that not only will this this net expansion metric come lower than previously expected, it actually means that this may not be the best metric to price this type of company. It's very difficult to know at this moment in time whether this is going to have a contagion in the market to other SaaS stocks. Looking at the after hours reaction at Cloudflare, at Twilio, those type of companies, it doesn't seem to be the case. It seems to be quite an isolated instance, and the market is taking that as an isolated instance. I will note that in the summer I actually had a position. I was long Fastly. I don't have any position right now, but I was also quite attracted by this stock. So I don't think that there's enough here for a person to dump the stocks. I wouldn't be dumping the stocks if I own it. And this is what's very important. This is really what distinguishes an amateur investor from a professional investor. The professional investor doesn't react to the news, it responds. You take your time to figure out where it really materially changes your thesis. I don't believe that if I was still long the company previously, I would be willing to sell off on the back of this news. Yes, it is bad news, but the rule of thumb is you do not sell into bad news. So let's move on to its valuation. Fastly is being priced at 43 times forward sales. Okay. Its competitor Cloudflare is also being priced at approximately 46 times forward sales. So these two companies are very much like for like. Cloudflare is possibly slowing down a bit faster. It's difficult to know right now because of the results from Fastly haven't been formalized yet, but these two companies are very much like for like. So I don't think that it really is enough for an investor to sell here. Just before we wrap up, what I will mention is that today Fastly's share price is just what it was 4 weeks ago. So although there's a lot of news coming out about this, it's actually not that meaningful. And investors should also bear in mind that when it comes to Cloudflare, it really does have a much higher non-GAAP gross profit margin. Its non-GAAP gross profit margin is coming up to 77%. whereas Fastly's is only at 62%. So it's a very large difference in the terms of the quality of the company, and that could have an impact also on how investors price Fastly going forward. But as I said, nothing has been formalized right now, so we should just really keep tuned to how its results come out in Q3. Thank you for listening. See you soon.